What if the biggest ticking bomb in the world isn't under a city or inside a briefcase, but on a spreadsheet? No red wires, no blue wires, just rows of promises that only work if the future looks like the past. And every time interest rates jump, the timer speeds up. You don't hear the tick until it's loud enough to shake your mortgage, your job, your pension. This is Dollar's Dance, in which we rig the money with simple stories to reveal the truth. And it's all about money. Today we're unpacking the global debt time bomb, what it is, how it was built, where the fuses run, and what it takes to defuse it without blowing up the room. First, a map of the bomb. The numbers are almost too big to feel. Global debt now sits north of 315 trillion, over 3 times the size of the world economy. But it's not one bomb, it's a bundle. Governments the biggest borrowers, funding healthcare, pensions, wars, and tax cuts. Companies from the factory you pass on your commute to the tech giant in your pocket. Households' mortgages, car loans, student debt, financial plumbing, the leverage hiding inside banks, funds, and shadow banking that looks safe until it isn't. Who's owed? Mostly us. Domestic banks and funds hold their own government's bonds. Pensions own corporate debt. Your savings account is the bank's liability. We owe it to ourselves is partly true. But the interest flows are not even. They run upward to those who hold the claims while taxpayers and wage earners service them. The system works until confidence hiccups. How a time bomb is built without anyone meaning to. For a decade after the 2008 crisis, money was cheap. Interest rates hugged zero. Central banks bought bonds by the trillion. Every problem had the same answer: borrow more and refinance later at lower rates. That cocktail did 3 things. It pulled future returns into the present. Asset prices rose. Debt felt painless. It taught borrowers to love short maturities, cheap, easy, roll tomorrow. It lulled everyone into thinking volatility had retired. Then the 2020s happened, a pandemic, supply shocks, war, and the fastest rate hikes in modern memory. Suddenly, the timer sped up. Not because the debt appeared overnight, but because the cost of carrying it changed. Inside the device, the timer, the fuse, the charge. The timer is the rollover schedule, when debts mature and must be refinanced. The fuse is the interest rate. Each hike shortens the fuse. The charge is the mismatch. Short-term funding of long-term assets, foreign currency debts without matching income, collateral that works until it doesn't. The fuses, room by room. Sovereigns. When the landlord owes the building, advanced economies carry heavy loads. The U.S. interest bill is racing toward $1 trillion a year. Italy's debt hovers around 140% of GDP. Its fate rides on growth and the European Central Bank's umbrella. Japan sits near 260%, a special case with a large domestic investor base and a central bank that pins yields by force of will. Emerging markets face a different demon: dollars. Borrow in dollars, earn in local currency, and a rising U.S. rate cycle tightens the noose. Sri Lanka, Ghana, and Zambia learned that painfully. Corporates, the wall of maturities. Companies gorged on cheap loans and bonds. Now a maturity wall is coming due. Leveraged loans with floating rates reset higher immediately. Commercial real estate battles, remote work, and refinancing at steeper rates. Private equity financed deals with debt that made sense at 3%. At 8%? Not so much. Zombies, firms that only cover interest, survive when rates are near zero. They stumble when money costs money. Households, the rate reset you can't negotiate. In the US, 30-year fixed mortgages insulated many homeowners. In Canada, Australia, the UK, Sweden, millions face resets within a few years. Payment shock isn't a headline, it's a kitchen table conversation. Consumption slows, delinquencies creep. Politicians promise relief they can't easily deliver without shifting the cost to someone else. The shadow system. The part that breaks first. In 2022, a niche UK pension strategy, LDI, nearly blew up the gilt market when yields spiked and margin calls rolled in. In 2023, a few US banks failed because they bought safe long bonds and forgot that safes still loses mark-to-market when rates jump. Each mini-crisis told the same story. The world had quietly wired itself to low rates. When rates moved, the hidden leverage surfaced. Where the wires cross, FX and commodities, debt and energy dance together. A spike in oil can widen deficits, crush importers, and weaken currencies, making dollar debts heavier. Food prices rise and political pressure follows. Capital flees, borrowing costs rise, and a loop forms. This is how financial fires become social ones. What sets it off? It's not math. Its mood debt crises aren't linear. They're sudden. One day, a government auction is covered but timid. The next day, a rumor becomes a rating watch. Yields gap. Refinance tomorrow becomes pay today. The mechanics are simple. Confidence slips. Lenders demand a higher rate or shorter term. The interest bill rises. Cuts and taxes follow shrinking growth. The higher rate looks justified by the weaker economy. Repeat until someone credible breaks the loop. Exhibits from the Blast Lab, Greece, 2010. A revised deficit number and the word unsustainable turned yields into weapons. Bailouts came with austerity. A decade of pain followed. UK, 2022. A fiscal announcement spooked gilt markets. Pension funds using leverage met a wall of margin calls. The Bank of England, in the middle of fighting inflation, had to buy bonds to stop the doom loop. Asia, 1997. The original sin, borrowing in dollars and lending in local currency, met a sudden stop. Pegs broke. IMF programs followed. A generation remembered. Argentina, again. Dollar debts plus politics plus drought equals default math. The pattern is cruel because it is familiar. Sri Lanka, 2022. Tourism collapsed, reserves dried up, fuel lines formed, government fell, spreadsheets became street protests. The scary part isn't the size, it's the speed. But here's the twist. Time bombs can be diffused. There are only 5 real tools. Every country picks a mix. 1, grow out of it. The cleanest answer is productivity. More output per worker, more energy without more cost, more innovation that raises real incomes. Nominal growth, real growth, plus inflation, lifts tax revenue and lowers the debt ratio if interest costs don't rise faster. Migration helps. Smart industrial policy can help. It's slow, it's worth it. 2, inflate it away, gently. If inflation runs above interest rates while wages keep up, debt melts in real terms. Economists call this financial repression. Savers hate it, governments love it. Post-World War II, it worked. In the 1970s, it broke the social contract. The art is keeping it mild enough to sustain belief. 3, austerity. Pain now, maybe stability later. Spending cuts and tax hikes can stabilize debt. Done too fast in a weak economy, they backfire, shrinking growth and raising the debt ratio anyway. Done credibly over time, they work. Politically, they're hard. 4, restructure or default. When the numbers simply don't add, someone takes a haircut. Brady bonds in the 1990s turned chaos into tradable instruments. Today's common framework tries to coordinate official and private creditors, including China. Restructuring is messy. It's sometimes the only honest choice. 5, devalue, control, or sell. Devalue the currency to regain competitiveness. Exporters cheer, importers cry. Use capital controls to slow capital flight, work short-term, costs long-term. Sell assets or raise one-off revenues, privatizations, spectrum auctions, resource royalties. None of these is a permanent fix. They buy time. What governments and central banks actually do in the moment. Central banks become dealers of last resort. Buying bonds when markets seize, lending against collateral markets won't touch, opening dollar swap lines so allies can breathe. Treasuries extend maturities, lock in today's rates before tomorrow's panic. Supervisors loosen rules so banks and pensions don't dump assets at the worst moment. Politicians review budgets and quietly trim promises. The word sustainable appears more often. Is the bomb good for anything? Debt isn't evil, it's a tool. It builds bridges, labs, and schools, things that outlast the loan. Debt turns ideas into factories before the profits arrive. The danger isn't debt itself. It's debt used to disguise stagnation, borrowing to paper over weak productivity, funding permanent spending with temporary windfalls, plugging structural holes with one-off tricks. The 3 stories the 2020s could tell. Story A. The slow diffuse inflation settles a bit above target. Rates drift down, not to zero, but to normal. Governments lengthen maturities, broaden tax bases, and trim waste. Productivity gets a boost from AI, energy buildouts, and supply chain rewiring. Emerging markets restructure in batches. Smaller, faster, with climate finance woven in. It's not painless, it's doable. Story B. The rolling pop. No grand explosion, just mini blasts in sequence. A property slump here, a sovereign wobble there, a pension scare in between. Central banks toggle between tightening for inflation and easing for stability. The time bomb becomes a maintenance schedule. Investors learn to live in chop. Story C, the bad break. Growth sags, inflation sticks. Rates stay high, then spike on a policy mistake. A large sovereign or bank loses access. The dollar surges, EM financing freezes. Panicked coordination follows. It's 2008 energy with 1970s inflation, what policymakers fear most. This isn't the base case. It's the tail risk that disciplines everyone's choices. How to read the timer at home without being an economist. Interest bill versus revenue. Is the government interest expense eating a bigger slice of the budget every quarter? The rollover calendar. How much debt matures in the next 12, 24 months? Short fuses or loud fuses? Who holds the debt? Locals with long horizons or foreigners with fast feet? Currency mismatch. Are debts in dollars while incomes are in pesos, lira, or rand? Current account and reserves. Is the country net earning foreign currency or burning it? Household debt service. Are mortgages and consumer loans crowding out spending? Real estate prices and vacancies. Property is the collateral behind a lot of loans. Watch it. Bank funding mix. Lots of repo and wholesale funding means faster runs when stress hits. The human part? Because this isn't just about charts. Debt crises break when trust breaks. A shopkeeper stops extending credit to a regular. A contractor asks for cash up front. A pensioner delays a purchase, just in case. Those micro decisions add up. By the time the headline reads crisis, the street already knew. Scenes you might actually see. Your bank app offers 4.5% on a money fund, and friends move cash in an afternoon. That's a vote about rates and about trust. A local government pauses a transit project citing financing costs. Concrete cools, layoffs grow. That's the interest bill arriving in real life. A politician floats a wealth tax, a VAT tweak, or a temporary levy on windfall profits. Temporary has a habit of lasting. Can we build a safer system without killing growth? Yes, but it's not romantic. It's plumbing. Longer-term debt at fixed rates, especially for governments. Automatic stabilizers that ramp up in recessions and fade in booms, without fresh votes each time. More equity-like financing for infrastructure. Returns tied to performance, not fixed coupons. Better resolution regimes so failures don't become bailouts. More sunlight on shadow leverage. Incentives that keep banks liquid in stress without hiding losses. And globally, coordination matters more than slogans. Faster, predictable debt restructurings. No mystery meetings, no endless court fights. Climate finance that swaps debt for real investment in resilience and energy, so disasters don't trigger defaults. Dollar swap lines used early and widely in a shock turning a scramble into an orderly queue. What you can do as a citizen or saver without building a bunker, prefer fixed rates over floating if you'll sleep better at night. Keep a cushion. Liquidity is boring right until it's exciting. Diversify across assets and, if practical, across geographies and currencies. Be wary of safe yields that are just leverage in a suit. Train yourself to think in what if rates move 2% either way terms. The quiet truth behind the time bomb. Every debt is a promise about tomorrow. If tomorrow is more productive, the promise holds. If tomorrow is the same but more expensive, the promise strains. The bomb isn't inevitable, it's a test. Can we turn borrowed time into built capacity? Picture this. A finance minister sits at a late-night table with coffee gone cold. The spreadsheet glows. One column is interest, one is schools, one is hospitals, one is bridges. That would pay for themselves over 20 years. But there's an election in 12 months. Across town, a small business owner stares at a loan renewal. The rate is higher. The order book is good. Risk and reward wrestle. On a train, a student looks at a tuition bill and a scholarship letter and starts a lifelong calculus of how much debt is too much. That's the real map of the global debt time bomb. It's not just in Washington or Rome or Beijing. It is in the daily choices of millions adding up to a system that either rolls forward or rolls over. Unpacking it means seeing the parts, the timer, maturities, the fuse, rates, the charge, mismatches, and the people whose trust keeps the device from lighting. Diffusing it means growth where it counts, honesty when it hurts, and institutions that can say no early enough to avoid saying sorry later. If this gave you a clearer way to read the tick behind the headlines, subscribe.